Broadly, the most common type of order that we have is the market order. Now, the market order is the order where we don't specify any price to the executioner, uh, and we just say, okay, buy me at the prevailing price in the market, the best buy price and the best sell price, depending on whether it's a buy order or it's a sell order. So when we send our order and it's a market order where we haven't specified any prices, when it reaches the market, it will be executed at the best price. The best price for a buy is the, I would say, the lowest, and the best price for the sell would be the highest. And because this is all done electronically, so when our order reaches the market, the prevailing market price will be the limit order is that order in which we specify the price at which we want to buy or at which we want to sell. So for example, the current price in the market is, let's suppose the current price is, let me take the example of a stock. So let's suppose Apple is trading at $125 now, but I want to buy it if it drops to 120, for example. So my limit order will be specifying that buy Apple's share only if the stock price drops to 120. If the stock price is at 121, it will not buy it. If the stock price is at 126, it will not buy it. So this is a limit buy order here, where I am asking the executioner to not buy for me unless the current price drops to what I am specifying, that is 120. Similarly, if I want to sell and I say, let's suppose I want to fix the limit sell at 135. So that would mean I have placed the order, but I'm telling the market not to execute it unless the price reaches this level, 135. If the price is at 134, it will not execute it. Anything below this price, this remains. When the market price hits this level, my order will be executed automatically. The good till cancelled order is an order where the order will be there unless it is executed. So for example, I placed this limit sale order here today, and today is 2nd of Feb. Excuse me. And if I don't specify that it's a day order, or what will happen, that it will be open until it is executed. So let's suppose today the market closed at 128. So the order has not been filled, but it will still remain there because it is good till cancelled. After 3 days, let's suppose the market price is 135 and the order is executed. So it will wait till the price hits the uh, level that I have specified in my order. Then the stop order is particularly, we also know it as the stop loss order, is particularly relevant when you are actually having a short position. So for example, I sold a stock for $120. Let's suppose it's the Apple share, and I was expecting its share price to fall below 120, and I will be able to buy at 105, and I'll make a gain of 15. This is my objective. However, there is a chance that the stock price may, rather than going down, may go up. So I may specify, for example, a price of $125, where I am telling the broker or the executioner that I have this short position where I have sold Apple for 120, and I expect it to go down to 105. If it goes down to 105, I will place a buy order and buy it back, and hence make this $15 gain. However, there is a chance that the market may go against me. So in that case, if the market starts going against me and starts to go up, like in the case of GameStop, that is what happened with the hedge funds. The hedge funds were expecting the price to go down, and they were betting on it. And what actually happened, that those Wall Street group guys on Reddit, they increased the price upward. As a result, these guys were having losses because they did not had stop loss orders here. So as a result, what happened is that their losses have been quite significant. Now, if you have a stop loss order here, you are actually assuming that the maximum loss you can bear in this strategy that you have devised for yourself is $5. So if the price, instead of going down, starts going up, if it hits 125, you will buy back the shares and you will incur a loss of 5, but you are happy to take that risk, but not beyond that. Is it clear? Then the all or none order. The all or none orders are is an order type where if you have a large order, for example, you want to sell 500,000 shares of Apple. This is a huge order. When this order comes to the market, there are sellers in the market, and seller A, B, C, and D. Seller A is ready to sell 100,000 shares. This one is ready to sell 50,000 shares. This one is ready to sell 200,000 shares. And this one is ready to sell 250,000 shares. However, this one is selling it for 120. This one is selling for 125. This one is selling for 120.55. This one is selling for 120.7. Now, if you don't specify anything, your order will be executed like this. 100,000 will be purchased for you at this price. 50,000 will be purchased for you at this price because it's a market order. So the best alternative price will be used. So the next 200,000 will be purchased at 120.55, and the next remaining, 150,000 will be purchased at 120.77. But if it is all or none, you are telling the executioner that if you cannot buy me all the shares at a single price, then you don't need to execute my order. So in this case, because 500,000 shares are not available at the same price, this order will not be executed unless we get the same prices quoted by different sellers, or we don't get one single seller who is quoting the same price for 500,000 shares or more shares. We have opening and closing orders. So opening order is when you open a position, for example, when you buy or sell. Okay, if you are having what we call a buy and hold strategy, so first your opening position will be a buy. If you are having what we call a short strategy, you will be selling. So your open position will be a sell order here. If you are a buy and hold investor, your open position will be a buy. Then to close, you will be doing what? The opposite. So if you are a buy and hold strategy, hold investor, you will be then selling. So you bought first and then you are selling to close the position. And if you are a short investor, so you first sold and now what you will be doing, you will be buying it back. So you see, first you buy and then you sell. This is for buy and hold. And in short, you will be first selling and then will be buying. How do expiration and exercise work in the markets? Particularly, we talk about the exchange here and then we discuss the OTC arrangements also. One of the simplest way to actually close a position is an offsetting order. For example, if I bought 100 calls on 2nd of Feb and I want to close it, let's suppose on the 15th of Feb. So what I do, this is buy. So I will do what? I will sell 100 calls on the same underlying, on the same contract. And what will happen? This is plus and this is minus, so my position will be squared 0. Same is the case with futures. If I buy or sell futures, let's suppose I sell 100 futures today, and then what will I do? On the 15th of Feb, I will buy 100 future, and then my position will be closed. So this is how it can be done in exchange market. The same goes for buying futures and then selling it, and then selling a call and then buying a call. So you can close the position. Options can also be exercised, and the exercise, because if they are exchange listed, the exercise can happen anytime between the contract is initiated and the expiration date. So I can exercise my right uh, after 3 days, 4 days of the contract initiation, or any time before the expiration date. On the expiration date, again, I have the option to exercise my right, or let it expire, depending on whether it is in the money, at the money, and out of the money. At expiration, if I exercise my right, I can get the physical delivery, or it can also be settled in cash. So for example, I have the right to buy Apple's share for $120. And this is 2nd February today. So I I entered this contract today. On the 2nd of April, the Apple's price is let's suppose $180. So what I can do, if I exercise my right, I can take physical delivery. So what will happen in a physical delivery? I will pay $120 to the exchange, and the exchange will give me 1 share of Apple. And how will the exchange give me that 1 share of Apple? It will ask, because I have a call option. Okay, I am the buyer. It will be asking the writers of the call. There will be so many writers. So let's suppose, you see, on the 2nd of Feb, this is the exchange. These are the buyers, and here we have sellers. And the buyers include me and so many others. And there are so sellers that include you and so many others. Okay, so I bought one contract, one call contract, and you sold the same one call contract. I don't need to know you, you don't need to know me, because we are buying from the exchange, so our counterparties are is the same, and we don't know each other. The contract has an exercise price of 120, and the spot price today was, let's suppose, also 120. On the 2nd of April, when the contract is expiring, let's suppose, we have here the exchange. On this side is me, the buyers, and on this side is the sellers. Now it's me. I come to the exchange and I deliver the $120, and I ask the exchange to actually give me the share. Now the actual mechanism is that I will have to inform the market in advance, 1 day or 2 days or 3 days, depending upon which market it is, that I want to take physical delivery. When I say I want to take physical delivery, then the exchange or the clearing house will contact the clearing agent, and they will contact the broker, and the broker will contact you to actually arrange for the shares that needs to be physically delivered. So the exchange will, through a mechanism, out of these so many sellers here, select one person randomly or one seller randomly. That is called an assignment. So for example, you were the guy who sold the contract to me. However, for the settlement, the exchange chooses somebody here, Mr. Y, for example. Mr. Y has been assigned to arrange the share for me, and this is called an assignment. Now, it is the responsibility of Mr. Y to arrange the share for me. If he fails to do that, he will default. I don't need to worry about if Mr. Y defaults. Why? Because the exchange will still be responsible for making the delivery. That is why I have to actually inform the exchange in advance, so that there is an arrangement available for the delivery of the share. So Mr. Y will buy the Apple's share, which is selling in the market for $180 on 2nd of April, that is ST. So he will buy it for $180, give it to the exchange, the clearing company, and it will actually give it to me, and I'll give the money there. So this person who is actually uh, giving me the delivery when I want physical delivery, I may not want physical delivery, But if I want my option to be physically settled, Mr. Y will be selected by the exchange randomly, and he or she is one of the sellers from here who actually deal in the same calls that I have. If I don't want to have a physical delivery, I can actually ask the exchange to arrange a cash settlement, in which case the exchange will credit $60 to my account because that is the cash settlement. I don't need to make a $120 payment. The net payment that the counterparty owes me is $60, and that will be credited to my account. Most of the exchange traded derivatives, they are not settled through physical delivery. They are mostly settled through cash. However, if the parties are interested in physical delivery, then there is an arrangement that is called an exchange for physical or against actual that can be arranged with the consensus of both the parties. The OTC market is, as we know, is a dealer's market, and in each of the OTC derivative markets, we have the market maker, and the market maker basically has a function, and that is to provide bid and ask. We say that the market maker provides liquidity or creates liquidity in the market. That is a very important job for of dealers. If I want to buy a swap, or if I want to enter into a swap, or buy a future, or buy a forward contract, or buy a call or a put contract in the OTC market, somebody needs to take the opposite side of the transaction. So if I go to a dealer, the dealer is actually making a market in it. By making a market in it means that the dealer provides us the opportunity to to buy or sell the contract to that dealer. And the dealer, as we know, earns the difference between the bid ask, and that is what we call the bid ask spread. So in a dealer's market, basically there are two parties to the transaction. One is the market maker or the dealer, and the other is the end user. So for example, British Airline, it wants to enter into a forward contract for oil, and it's not interested in futures market, and we will later on see why. So British Airline actually is interested to buy oil using a forward contract to hedge its risk. So what it can do, it can go to a financial institution that is dealing in the OTC derivative market. The financial institution, maybe let's suppose it is HSBC. British Airline is the end user because it is the party that needs the forward contract for risk management purposes or speculative purposes, whatever it is. And HSBC is the market maker in this case. So in the OTC market, we will have end users and the market maker, and they will have different motivation to enter into the transaction. The trading platforms are now available for OTC markets, and even now for swaps, we have electronic quotation systems, and these platforms are now providing swap execution facilities. So if you want to enter into a swap as a fixed rate pair or as a fixed rate receiver, you can see these quotes available through different trading platforms. Some times ago, 10, 15 years ago, it was not possible, but now it is possible for swaps to even have their own electronic quotation system, just like NASDAQ. OTC contracts, as we have discussed, are customized between two parties, so they are bilateral contract, and that's why there is a huge credit risk, counterparty risk involved in OTC markets. The ISDA is the you can say the regulator that regulates swaps and derivatives market. It's called the International Swaps and Derivatives Associations. It actually has come up with the master agreement, that is a standard agreement for OTC contract. Most of the contracts that are there on the OTC that uses this standard master agreement, which actually outlines the rules and regulations that will govern the contract. These are just graphs that show the notional value of the OTC markets that have actually seen significant growth over the last 20, 30 years. So you can see how the notional amount and market value of the OTC foreign exchange and interest rate forward contracts have gone up. So it's billions of dollars. Okay. And then this is the swap market, and you can see it's nearly 4 times of what the forward market is. And then it is the equity options, the interest rate options, and the foreign exchange options in the OTC market. It's at, I mean, like in 2013, the notional value was around 80 trillion. So you can see that the options are relatively smaller OTC market compared to the forwards and the swaps. So swap is really big in terms of numbers when it comes to OTC derivative market. Now, on the OTC markets, if you want to terminate your contract early, because it is an agreement between two parties, the buyer and the seller have contacts directly. So whatever you want to do with the contract, you will have to do it with mutual agreement. So if I have purchased, or you can say, let's suppose if I am the fixed rate payer and in a swap contract, and you are the fixed rate receiver in the swap contract. If I see that interest rates have gone down, I would want to terminate this swap. Why? Because if I continue in this swap, I will lose value. So I want to actually reverse this. So I cannot do it myself unless and until you agree with me. And for you to agree with me, I have to make payments to you. So to terminate this swap contract, let's suppose it is for 2 years. And after 6 months, I have realized that interest rates are going to go down. So if I continue in the swap, I'll keep on paying you a higher fixed rate than the interest rates prevailing in the market. So you are the winner. If I want to terminate this swap contract after 6 months or after 9 months, I need to make you agree to it. And of course, that you will not agree easily. You will require compensation for it. If you don't agree, what I can do, I can enter into another swap where I actually become a fixed rate payer receiver, and the counterparty becomes a fixed rate payer, and that will actually cancel this payment. So that is another possibility that can be done. However, what will that do? If I enter into another swap, let's suppose the swap will be for 1.5 years, okay, and there I become the fixed rate receiver and the counterparty becomes the fixed rate payer, okay. So what will happen? The first thing is there is a huge financial risk in which I run credit risk here and I run credit risk here, so it increases counterparty risk. Okay, the financial risk will offset. For example, if interest rates are going down, so because I am receiving fixed here, so I can use that fixed to make the payment here. Okay, and in a way offset this. However, the problem is that I have not reduced my counterparty risk. In fact, the counterparty risk may increase. And cash settlement is also common in OTC markets, where you don't take physical delivery, rather you just offset the payments, and the net payment, whoever is due to makes the payment to the counterparty. Now, this is very important, and particularly it's quite relevant to what I have shared with you regarding Robinhood last night, and you must go and read that article where the CEO was telling in his interview that he received a call from the clearing house at what time? 3:30 a.m. when he was sleeping. And what was the call? The call was a margin call asking Robinhood to deposit $3 billion in a day. Okay, just imagine. And who was making this call? The clearinghouse, not the exchange, not the New York Stock Exchange, not NASDAQ or any exchange, the clearinghouse. So we will see how it works. Now, you see, when we talked last week, we said that there are two things that happen. One is trading and the other is settlement. When we say trading, we say price, okay? And when we say settlement, then it means delivery and payment. So price is determined on the floor of the market or the in exchange. So you see, in derivative exchange or the stock market or whatever market it is, the market will itself be used only for agreeing on the price to buy and the price to sell. Okay. However, the settlement will be taking place through clearing house. When the payment will be made and the delivery will be received, that is the clearing house responsibility to do it. Now, let's suppose I entered into a future contract, okay, or a call contract or a put contract with you. So I am the buyer and you are the seller. I have my broker. Let's suppose my broker is Robinhood. Okay, let's make it like this. And your broker is, let's suppose, let's make it eToros. We are just assuming they are trading platforms. They may not be, the brokers. They may be like commission brokers also. Okay, so for example, eToros may not be having a membership of the New York Stock Exchange. What eToros may be doing is using another broker who has direct access to trading in New York Stock Exchange. So it may be a commission broker in which I use its platform, but this commission broker has actually uh, an account here with the broker here, or my broker here has an account here with this broker, and that is trading here. So it may be a commission broker, but for the sake of this example, we are assuming that these two have exchange memberships and they have exchange presence here. They can they are represented here. They have seats on the exchange, in other words. So I bought 100 contracts, call contracts or future contracts or put contracts, and you sold it. When I do this and you do this, we channel our order through our broker electronically. When our orders reach the market electronically, they are matched. We don't know each other, and the transaction is done. So what happens from my account with my broker, there is money inside it. So that money is in margin account. Okay. And that margin is then actually shifted to the buyer's brokerage clearing firm. Now, it is possible that the Robinhood, which is my stock broker here or derivative broker here, it may also have membership of the clearing house. So Robinhood is my broker for the stock market trade, and Robinhood also has membership of the clearing house. Okay. However, it is not necessary. In many countries and in many markets, it may be the case that Robinhood has membership of the exchange, but Robinhood has no membership of the clearing house. In that case, Robinhood will be having its own broker who will be representing Robinhood and ultimately me here in the clearing house. And Robinhood will be paying that third party a commission or a fee for this service. But let's assume for the time being that Robinhood and eToros are also members of the clearing house. So they have here, presence. It's not necessary. I mean, so uh, Robinhood has, let's suppose, clearing house memberships, and eToros also have clearing house. If they don't have, let's suppose we have let's make it like this. Let's make it ABC company and XYZ company. So Robinhood has a clearing firm ABC that represents Robinhood in the clearing house. And Robinhood has a clearing account here with this clearing firm, and eToro has a clearing account with XYZ. So the margin deposit that I have kept with my broker will be transferred to the clearing firm, which is ABC, and the margin deposit that you have kept with your broker will be transferred to the XYZ company. Now, if it's a future contract, we have set the price today. What will happen as the future price changes each day when the market is mark to market? What will happen? The gain or loss in our accounts will be settled. So if I make a gain from your margin account with your broker, who has a margin account with the clearing company, money will be transferred through the clearing house to this clearing firm, and this clearing firm will then transfer it here. So I will see my margin deposit going up. You will see your margin deposit going down. Whenever I make a gain, this is what is going to happen. When there is a loss, my margin deposit will go down and your margin deposit will go up, and the clearing company is responsible for this mark to market, not the exchange. This is what is going to happen. If I want the delivery, the clearinghouse is responsible for arranging that. So if on expiration of the derivative I want delivery, I will intimate the market that I want to have delivery. My broker will then intimate here the clearing firm. The clearing firm will then ask the clearing house to make the arrangement, which will then actually sort of ask somebody from this side, which may not be you. Okay, remember, which may be anyone the exchange assigns. And then what will happen? I'll make the payment, which will flow through here to clearinghouse, and the clearinghouse will then make the payment here, which will then make the payment here, and then here, whoever is assigned, and I'll get the delivery, and the counterparty will receive the money, but that will be at expiration. Is it clear? So you see, the trading takes place on the floor, but that's the job of the market. That's done. The market then does nothing. It just relays that information to the clearinghouse, when then requires everybody to actually do the clearing arrangement, margin deposit. If it is a delivery, then make arrangements for the delivery. Now you see, when I said Robinhood received a call, so you see Robinhood, for example, its broker, who is a clearing firm that has membership of the clearing house, called Robinhood to deposit $3 billion. Why? Because of the increased risk. The prices of the companies AMC and GameSpot and a few others have significantly increased. Our brokers may be having different margin requirements for us than the broker clearing firm has for Robinhood. So keep that in mind also. So if we are required to have a 5% margin deposit, it's not going to be the same for this buyer broker to have the same requirement by the clearing firm. It will be different and it will vary. The same is the case for options. The same is the case for stocks. It's just only what payments. Okay. Now have a look. The only difference here is that when I am buying an option, I will pay the premium, while the seller will actually be keeping a margin deposit. So I'm not required to keep a margin, but the seller is required to keep a margin. And the reason for that is, as options are asymmetric payoff contracts, the maximum amount I can lose as a buyer in an option contract is the premium I paid. So you see, the exchange would never ask me for any margin. However, the seller, on the other hand, is required to keep a margin because the seller's liability may be unlimited. Okay, so the seller will have to keep a margin deposit with the broker that it uses to sell the derivative, and again the remaining mechanisms are the same. Next is Daily settlement. So as we know that the clearinghouse has a very important function, and that is to reduce or manage the credit risk, the counterparty risk in a transaction. And I told you that when I and you trade, we don't know each other. This is the exchange. Okay, it's like a wall. So I don't know who is on the other side of the trade. You don't know who is on the other side of the trade. You can default, I can default, but we don't worry about the other party defaulting. Why? Because I am doing my trade with the exchange and you are doing your trade with the exchange. So for us, the counterparty is the exchange, not each other. So the exchange uses the clearinghouse mechanism to actually safeguard itself. And how it does, when I and you trade, we both are required to keep margin deposits. If it is a future contract, and if it's an option, then only you or the seller will be required to keep a margin deposit. So let's assume it's a future contract. So I will be putting in margin and you will be also putting in margin uh, in the accounts that we use to trade. So these margins will be used by the clearinghouse to offset gains and losses on daily basis. So if there is a gain for me, it will be deducted from your margin deposit and it will be um, credited to my account. If there is a loss to me, my margin deposit will be debited and your margin account will be credited with that. And to make sure that there is enough money available in these margin accounts, the exchange uses the mechanisms of maintenance margin, initial margin, and margin call. So if we go here, we see here that when we start the trade, the exchange says you must deposit your initial margin. In futures market, uh, depending on the type of underlying and the volatility in the some underlyings are more volatile, some underlyings are less volatile. So depending on that, the margin deposit may range up to 5% at times 10% of the underlying value. So if I have a future contract that is worth let's make it 100,000 pounds, I will be required to keep, let's suppose, a margin deposit of 5,000 pounds. Okay, depending on what the margin initial margin requirement is. So and then a maintenance margin, for example, based on this, I'm required to keep at any point of time in my account. This is the initial margin. At any point of time in my account, the minimum maintenance margin should be around let's make it $2,000, 2,000 pounds. So if I suffer losses and my margin starts falling, if it reaches 2,000 or below 2,000, then I will receive what we call a margin call. Okay, so my broker will call me and say, look, your margin deposit has gone below 2,000 and it is now at uh, let's make it 1,600. Let's make it 1,600. So you need to deposit more money, okay? Because the maintenance margin is set at 2,000. This is the minimum my margin can be at any time during the open trade. So it is 1,600 now. So I will be required to deposit some money. That is called a margin call. If it is a stock market, in stock market, the margin call will be 400. So I will have to only deposit 400 to get back to the maintenance margin level in stock markets. But in derivative market, if it is based on derivative market, if the margin call will be requiring you to deposit 3,400 pounds so that your margin goes back to the initial margin. So the difference between the maintenance margin for stock market and the maintenance margin for derivatives market is that in stock market, you will be required to deposit $400 or 400 pounds so that your balance goes back to the maintenance margin requirement. But in derivatives market, your margin will be requiring you to actually go back to the initial margin requirements. Is that clear? Let me give you an example here. Let's suppose I opened a future contract at today on the 2nd Feb. Okay, and the future contract position is that I have one, let's make it 100 futures contract on Apple. Okay, and the margin requirement is, and let's suppose the price at this level is, let's make it 1 so that we understand what, no, keep it 100. Okay, at 120. This is the price at which we purchased it. And the margin requirement for this is, let's make it 112, so to 12,000. So let's make it 500 pounds or dollars. Today, this is the position I opened at around 11 a.m. in the morning. At 4:30, let's suppose at 4 the market closes. 4:30, let's make it p.m. When the market closed, the price is 115. And also, let's say the maintenance margin is 3,500. Okay, 3,350. Let's make it 115 and 350, the maintenance margin. So at 4:30, the market closes at 115. Now, the opening position was 120, the closing position is 115, and I was having a long position in the future contract, so I have lost $5 per contract. Let's make this 1,500 and let's make this 1,000. Let's make it 800 maintenance margin. So I have lost $5 per share, and I have 100 shares in the future contract. So 100 multiplied by 5, that means my loss is 500. So my initial margin deposited was 1,500 and my maintenance margin is 800. So the exchange has my account where I have 1,500 here as balance at the start. I lost 500. So my closing balance is how much? 1,000. Okay, this is for this 2nd Feb. So 1,500 and 1,500. Now, after the first day, I lost 500. So my balance was 1,500. It has dropped to 1,000. I'm not required to deposit any money because I'm still above the maintenance margin. On the 3rd of Feb, the market closed at, let's suppose, 4:30 p.m. The market closed at 112. Okay, so that means for that day, the previous day close was 115. So that will be considered as the opening price. So I have suffered a loss of 115 minus 112. That will be 3. So 100 into 3 is equal to 300 is my loss. So the 3rd Feb account would look like the balance was 1,000 and I suffered a loss of 300. So my closing balance is 700. So what will happen? Because my maintenance margin is 800 and I have gone below that. So my broker will give me a call and ask me to deposit money. That call he makes is a margin call because it is requiring me to deposit additional funds into my account. And how much funds I am required to deposit? If you look, my balance is 700 and my maintenance margin is 800. So if it was stock market, I would have just deposited only 100. But if it is a derivative market, so I have to deposit enough money so that I can get back to the initial margin of 1,500. So I need to deposit cash of how much? I need to deposit cash of 700 and 1500, 800. So if I do that, what will happen? This will be 1800 and my balance will now move to 1500. So this is how the mark to market works, and this is how the uh, margin call is made. This amount that I deposited, this 800, is called variation margin or variation call. Okay, that is the amount of money that I was required to put into my account so that my balance increases from 700 back to the initial margin 1500. Any question on this? Then we have market participants. So market maker, as I said, are the dealers who provide liquidity in the market, and they have this bid ask function where they enable trading to take place for any security or instrument for which you are unable to buy any buyer or sell in the market. I'll give you an example of this. Let's suppose you are trading in a market and you have placed, you want to buy Apple's share. Okay, you want to buy, let's suppose, 1000 shares of Apple. It's just an example. You place this order, however, there is no one selling Apple's share right now. For example, you want to buy shares of GameStop. Okay, or you want to buy or you want to sell. You can buy or sell both. Right now, uh, buying is difficult because of the restrictions. Let's suppose even there are no restrictions in the market. You want to buy GameStop share, but nobody is willing to sell them because everybody is quite bullish about it and people believe that they should hold the shares. So you want to buy 1000 shares. No one is available to sell these shares to you. So if there is a market maker or dealer who deals in these shares, you can direct your order from the exchange market to the OTC market, and it's possible electronically, though retail investors don't have that facility, but others do have, institutionals in particular. So you can direct these orders to the to the market maker, the dealer, who will be actually bidding, and uh, he will have a bid price and have a ask price. So here, because you are buying and the dealer is selling, so this side of the transaction will be um, or the bid ask spread will be applicable. So the dealer is actually filling your order here. If the dealer was not here, your order will remain unfilled, and that will be not good for the market, because in such a situation, the market is lacking marketability, and it's also lacking liquidity. Okay, you want to buy something and no one is selling it, and you are unable to fill your order, or you want to sell something and no one is ready to buy it, and in that case the market will not be considered a good or liquid market. So market makers have a role to play in the market. Their role is to actually provide liquidity, and they are not only present in OTC market, but they are also present in exchanges, and they do this function. Okay, any question on this? Next we have scalpers. And scalpers are basically, you can say, very good examples of scalpers are like, the high frequency traders, HFTs. They hold a position for a very short period of time, a few minutes. They trade, buy and sell at a very high frequency. This is something very risky because the transaction costs are a very potent element of the profit and loss for any trade, and scalpers have high transaction costs. Uh, so therefore, they have to be making a lot of money to remain profitable, and it's a highly risky strategy. Then the floor brokers are those who are actually representing the broker or the member on the floor of the market, and they actually receive commission and they execute orders for both their employer and as well as non-members of the exchange. And this is particularly relevant for the physical trading. For electronic trading, we know that it's mostly not essential. Then we have traders, and then there are two types of traders. One is a position trader. A position trader is someone who believes a particular stock will go in a particular direction because of his analysis, whether technical analysis or fundamental analysis. So you don't make a position just only on a you know on your short-term view about something going up or going down, but you have an understanding that something will happen. There will be something that will cause the stock price to move in a particular direction. And a very good example of this is the GameStop, where we saw that hedge funds were having a position which was a short position. They thought that GameStop was overvalued and its share price will go down, and they have sold this share short. So they were proven wrong. So these are position traders who are actually betting on the stock to move in a particular direction because they have done their analysis, whether technical or fundamental, that or both, that suggests that the stock is overvalued or undervalued and it will go in a particular direction. Then we have the arbitrageurs, okay, and they seek profits from misalignment of prices. Now, how is this different than the position traders?
So arbitrageurs look for multiple positions.
Yes, good. Yes, but can you explain that more? You're right.
So like a price discrepancy between two positions, and they might open one in a buy, one in a sell to cancel out the risk.
Yes, you're quite right, you know.
Position traders, obviously they make money by the price movements, whereas arbitrageurs wouldn't necessarily be as concerned with the price movements over a particular time period.
Yes, the arbitrage will enable you to eliminate all uncertainty about future. So that makes you don't worry about any of the price. Like you see, if you look at the GameStop position, the hedge funds have lost money. They were position traders. They were not arbitrageurs. They were doing what we call risk arbitrage. You know why? Because they didn't had any stop loss. For example, if they had a short position in GameStop, they were expecting the price to go down. They should have also have had some risk management. For example, at the least they could have done is actually to have some stop loss. Okay, they didn't had that. Now, what the problem was, what the other thing they could have done is that they could have purchased call option. You know why the GameStop was further aggravated? The GameStop price was further aggravated, or crisis were further aggravated, because these hedge funds, institutional investors, once they saw that GameStop price is going up, only then they started to jump and buy call option. Okay, if you read the articles that I have shared, the trading volume of call options on GameStop increased many times. I mean, like, 10 times from their regular. If on a regular basis, the call options were there, like, let's suppose in 5,000, they increased to 70,000. Why? Because these hedge funds, they took a position without hedging it, and now they realized the risk was realizing for them, the price was going against them. They said, oh, we need to buy a call option, so in case if we have to close the position, we have the right to actually buy at a fixed price so we don't suffer losses. And that further added to the problem, and that is where the gamma squeeze become even more dangerous, and it affected them even worse. Like, somebody is sick, okay, and he's not taking medication, and then suddenly he or she realizes, oh, it's quite bad, this disease or this sickness is quite hard, and you start actually taking medication, but the timing of the medication is such that you are not able to administer it at the right time. So what happens is that rather than it helping your body and your sickness to actually go down or reduce, it actually aggravates the problem. And this is exactly what happened. They tried to cure their position, which was previously unhedged, through hedging, and that hedging actually started to affect them. Just imagine, you have an open trade, you haven't hedged it, and now you are trying to hedge it, and the hedging is actually, like, cutting you again from the other side, because when you started to buy more calls, when more calls are bought on the underlying, that even further increases the demand for the underlying. So the share price was not only increasing because the investors were buying the shares of GameStop, like those retail investors from Reddit, Wall Street Bet, but it was also increasing because the hedgers, the hedge funds, they started to buy call options to protect themselves. And when they started to buy call options, that created further demand for the GameStop stocks, because you need to deliver them in the future. And that is where it actually became so much funny. And so many people lost. I shouldn't say, because there were hedge funds that have lost billions and billions of dollars. Uh, it's a completely I mean, like, six months ago, 1 year ago, nobody would have thought of it, but this has happened and it's a reality. Okay, and uh, this is where the gamma squeeze comes in. Okay, they were short squeeze and they actually, like, put themselves into the gamma squeeze also. So arbitragers actually take advantage from the misalignment of prices. So what does that mean? They will take zero risk, they will make zero investment, and they will earn positive returns. The three conditions. Okay, the position traders, they are not arbitragers. Why? Because they invest out of pocket money. Okay, they take risk, or they are open to losses. For example, the hedge funds in this case, though they were not putting money out of their pocket, but their position was open to risk, so they have suffered losses. Arbitragers, on the other hand, they will have zero risk, they will have zero investment of their own, and they will still be making money. That is what we know of arbitrages for derivatives. Okay, any question? Now, if we talk about the transaction cost in derivatives market, so we have the floor trading and clearing fees, commissions, the bid-ask spread, the delivery cost, and other transaction costs related to settlements, etc. And then we have taxes, which is very important element, but they vary from country to country depending on the tax regime. And then there is the regulations of the derivatives market, and I would strongly recommend that you study this and you read about it, not only from the book, but you also read about it from online, because the regulations have been increasingly increased in numbers as well as in terms of their rigidity. And the recent example of GameStop and Robinhood has actually, I mean, like, there are now contingencies that are taking place. So we see everybody intervening. The Securities and Exchange Commission intervening. We see the international, the financial authority that looks after financial institutions in the U.S. intervening, and then we see the U.S. Congress intervening, and then the individual firms themselves are actually trying to regulate, like the Robinhood's decision to halt trading for GameStop and other stocks is actually an example of self-regulation.